I'm going to give you a saying that we say. We say you're too focused on the product, not your prospect. What problem are you actually solving that people are willing to pay for that no one else can solve?
There's a saying like if you have a hammer, everything looks like a nail. That's especially true for scientists. Understandably, they often fall in love with their problem.
And I think that that is such a crucial lesson because I talk to a lot of founders that are in deep tech space that are like, I need to raise tens and tens and tens of millions of dollars, and like they have no product to show. They're like, there's 10 more years in between now and anything's going to go to market.
Think about Elon Musk, right? He has a really clear problem he wants to solve. It does not really matter what kind of technology he's using as long as it works, right? So that is the kind of mindset ultimately, like if you really want to build a great company.
Hello, everybody, and welcome back to the Startup Shortcut. Today, we have a good one planned for you. I have Hongkai here with me today. He is the general partner at Taihill Venture, a pre-seed deep tech VC firm based in Boston. He has a background that includes co-founding Talent Jungle, working at BAC Investment, and establishing Boston Innovation Growth. Hongkai has actually been involved in over 120 investments. He's also a mentor to several startup accelerators and serves as the vice president of the US-China Health Summit. Hongkai, good to have you here.
Thank you, Michael, for inviting me. Great to be here. Yeah.
Absolutely. So in your own words, I always like to start with, just tell me a little bit more about Taihill Venture and really your aspirations there, what you're working on right now.
Yeah, sure. So we started doing this like since 2017, initially like as a family office. So at that time, my partner and I, both of us, we were very focused on deep tech. So think about this. In the past 3 decades, we enjoy the applications on top of a few very powerful platforms like the semiconductor, personal computer, internet, and mobile internet. So which back then were all considered to be a deep tech platform. So now we see more and more this kind of like new platforms coming out, like emerging simultaneously. Like you think of like gene editing, quantum computing, AI, advanced materials, robotics, etc. So as a result, we think there will be more problem to be solved, more value creations, and more investment opportunities on top of it. So that's why we choose to focus on deep tech from day one. And then that's also why we choose to be in Boston, because we have MIT, Harvard, we have the, I would say, absolute most PhD scientists in the world. So yeah, that's why we do in Boston. So like while you're talking about like aspirations, I think what we hope is that like our slogan is like, we shape our future today. So what we hope is that like we successfully support and invest in some founders, and then they turn something impossible into possible and solve some like very hard technical problems and some like so that we change the world. So with technology, so that's ultimately what we hope. What makes us feel like the sense of achievement.
Yeah, that makes a lot of sense. It's really cool. And I like the way you were talking about like previous technologies, like deep tech, the definition by nature is fluid, right? Based on technologies that come out that become normalized to all of humanity, right? Like the internet was deep tech. I actually think that's a pretty interesting point. I mean, tell me a little bit about like the types of deals that are most interesting for you right now. Tell me also about the check size you're writing. Do you follow? Do you lead? Just give me a little bit more context, I suppose, on the investment style.
Yeah, like for example, like one deals we recently closed is like a company coming out from University of Maryland. So basically they figure out ways to heating up materials and cooling them down in a fraction of seconds, like from like 100 degrees to 1,000 or 2,000 degrees, which is like, this is very unique because if I think it this way, like whenever we figure out a new way to control temperatures, we figure out a new way to create new materials. This is for the first time we figure out a way that we can control temperature at the resolution of chemical reactions. Meaning because we can control temperatures so precise, so quickly, it can actually stop reactions or it can actually basically form a new form of materials. This is kind of like a typical platform technologies. They can use to make new catalysts, make new membranes. They can use this to like break down like plastics into like monomers, into some other like different useful raw materials. So we help the scientists from University of Maryland to think through this process, to form the companies, and we are the first investors into the companies. So this is one very typical examples. Yeah.
Wow, that's incredible. So you're literally the first investor. So you wrote the first check for this company,
Oh, yes,
essentially.
exactly. Yeah. Yeah.
Wow, that's incredible. So I feel like there's like a stigma out there. Some VCs say they want to be the first check, but then they actually wait for
Hmm.
the seed round or a lot of progress to occur. So it's always really cool when you find people that are like, boots on the ground, helping with the value creation of the company. Truly, it's really incredible. So you mentioned that you're really helping them think through this. So this is a really big problem. I like this company that you brought up because, like you said, materials, like there's shortages for different types of materials, and if you can literally create new material, then I mean that's like an unlock for a brand new industry potentially, right? So tell me a little bit about like what you do. How hands-on are you as a firm, and what's your value proposition per se, your value creation process for the startups that you get hands-on with? I'm curious about that.
Yeah, sure. The honest answer is like it's case by case. Some startup we are more hands-on. Some startups we are like just a financial investors. So we usually see ourselves like it's kind of like a connector. We bridge the gap between like viable business. Let's put it this way. So basically we try to we get in touch with like scientists, like PhD, young professors, senior professors, like or industrial researchers early on when they have some amazing science discoveries. We talk to them, we brainstorm with them, like what kind of applications can be built on top of their platforms. Well, usually a lot of these technologies, like I mentioned, the one from University of Maryland, they are platform technologies. They can be used to do different things, but we help them to think it from like a business perspective. Is this doable? Is the product like easy to make? Is it scalable? Like I said, like economically speaking, whether the input and output, like the cost structure, the labor involved is like economically viable. So whether making something like this complexity is manageable, something like that. So that's how we see like before investments, we will get involved with them. If you look at our past portfolio, sometimes you will see founders, we start to engage with them like a year before we actually write the first check. Because a lot of time they are thinking about it. Like it takes time. And then maybe they are waiting for their publication to be published. They are waiting for a good timing so that they can commit more time into the companies. So we get in touch with them early, like kind
Right.
of like we help them. Yeah.
And I actually really like that. We'll transition to that a little bit because I think that that's a mistake a lot of startup founders make is they think that they'll just talk to an investor and then, the capital will be raised if that's their goal, right? But
Yeah.
really it's about like the right time for the capital and the relationship that you build over, it could be months, it could be 6, 12 months, even years, like for people that
Yeah.
invest in later stage rounds. So one thing I want to ask you about it, I actually really like, I don't want to call it a funnel just to make it sound less cool and probably
I mean,
meaningful than
it's
it
a
is.
funnel. It's technically. Yeah.
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 So I mean, like, just if you break it down, right? But I like the fact that you recruit from like the top talent pools, right? Like you put yourself so strategically positioned next to MIT, Harvard. It makes sense. People go to the Valley for same reasons to get access to
Yeah.
capital. So do you only invest in founders that are from those universities, or tell me a little bit about like how you go about that decision making process?
So the answer is no. Like we don't have like a kind of like a hard standard that they have to go to MIT, Harvard, or like the Ivy League or that kind of universities. It is just that by nature. So the type of problem we are looking for. So again, like Taihill is looking for breakthrough technology solving long existing problems. Those problems, when I say long existing, usually it means like it's hard. That's why it's long
Hmm.
existing. So usually the kind of solutions coming out, like the kind of breakthrough, more likely coming out from a top university labs. Sometimes it comes
Yeah.
out from like industry. So that's like I would say statistically, that's why we see more founders coming out from top universities. It is not
Hmm.
that we only look at founders coming out from like top
Yeah, it's just
universities.
naturally they end up there. If they're
Yeah,
building a
exactly,
life-changing technology that you're interested in investing in, that's typically where they're going to
exactly.
end up. Yeah.
Yeah, yeah.
Yeah, that makes a lot of sense. Yeah, and I mean, I think that that's what, a lot of founders face. It's when they maybe didn't go to a prestigious university and they're trying to
Mhm.
break into that. Do you have any words of wisdom or advice for founders maybe that didn't go to Harvard, MIT, but are working on something that they consider a breakthrough technology? Is there a strategy for them to, affiliate more so with those types of universities, or a way for them to stand out to you so that you'd consider them? Like, give me a little bit of perspective for the founder who did not go to one of those more prestigious universities, because I feel like that's a pretty
So
common issue.
Yes, yes. So let's think it this way. Like, so ultimately, why are we looking for those top universities or like say top publications, like peer review papers?
Hmm.
One big reason is that because we don't know ultimately whether the technology will work or not. So we want some early signals that something that we can understand that prove that at least at this stage, this is very good. So it does not mean that like if you don't have like great publications, it's not good, but you need to provide some other like kind of proof, like proof of
Yeah.
concepts, like proof that something is working. So I would say ultimately, as long as you have something to convince the investor it's working, well, I mean,
Mm.
conceptually it's working. So it's working at least for now, and it has a promising futures, like evolve a back, then I think it would tell the story. Like those top university students or PhD or scientists, like the basically the title themselves tells part of the story. That's what makes it easier for them.
Yeah, I actually completely agree. So, a big a core principle for my company in terms of where we advise startups, it's you have to have two things before you ever approach an investor. There has to be perceived value. So there has to be
Mhm.
something perception wise, and that could be the degree, that could be your board, your team, it could be like peer reviewed articles, whatever it may be. But then there has to be like real tangible demand or traction in some degree, like something based on the stage and the market standard for like viability of what you're building.
Oh,
You know
you're
what I
totally
mean?
right. You're totally right.
Yeah.
Yeah.
And I think that that's the perfect concoction. You have those two things, and then that's the time to start talking to some investors. Cool. Well, let's pivot. There's something that you said when you and I were chit chatting before this that I really quite liked. You talked a lot about you focus on capital efficient deep tech. And I wanted to open up that conversation because I really liked your view on that. And I just want the everyone that's listening to this to really understand what that means. And yeah, so if you want to just explain what is capital efficient deep tech, and we'll take the conversation from there.
Sure, sure. So I will start from like traditionally how we see like deep techs. So basically traditionally people think like deep tech has been like synonymous like or with like long R&D cycles, heavy capital requirements. And then like what does that actually mean? From like a founder's perspective, that means your lifeline relies mostly on external investments and support for quite a long time. Then your feedback loop to know whether something will work or not, or whether something is you're doing it right or wrong will be quite long. You may waste a lot of your time and your hard work and your monies on like a wrong or not ideal directions for too long. So it means you need to raise a lot of money, which sometimes is very hard for a lot of founders. So what does that mean for like investors? It means like the company is likely to need more fundraising. So like early investor will get more dilution like us. We will suffer from like significant dilutions. And on the other hand, it takes longer to grow to an exit point, which means ultimately means like longer time, less return multiples, meaning lower IRRs as like a KPI for our fund. So this is actually less a problem when the market is good, meaning like if you have like a loose monetary markets or expansionary monetary markets, like from ever since from 2008 to like 2021, that kind of markets. So but it will be a big problem if we see like a tight monetary markets or a market like something like right now. So we challenge this kind of like old school way of thinking. So yes, like big dreams are great, but you need to have a practical plan to get there.
Mm.
So we've invested over like 120 companies. So we've seen successful and not so successful examples. We see that what we learn is that we can actually purposely build companies. Deep tech does not have to be slow and expensive. There are multiple ways you can think of it. There is like simply no one answer. So maybe you
Mm.
choose a product that is easier to make or is less regulated, or you
Yeah.
focus on customers who are willing to take more risks, or their process is actually faster, your sales cycle is faster, they are less picky, or you choose a business model that is less dependent on external partners. Like think about things like a lot of founders, they say, oh, from day one I want to build a platform. Like a platform, you need to create value for every parties if there is like the existence of other parties. If you get involved like 3, 4 parties, you have like chicken eggs problems, right? And then you need to burn some monies to get the momentum going. This is like a typical example that your value creation relies on too many parties that it's out of your control. So it's not like the absolute answer, but the sum of this kind of like angles or principles, you can think it through so that you can be smart about capitals, be smart about what kind of resources you need. So we say like startup can be designed to be less dependent on outside fundings, moving faster and getting to self-sustain sooner. That's what we call in general, like capital efficient deep tech.
Yeah, and I think that that is such a crucial lesson because I talk to a lot of founders that are in deep tech space that are like, I need to raise tens and tens and tens of millions of dollars, and like they have no product to show. They're like, there's 10 more years in between now and anything's going to go to market. And to sell an investor on that in today's day and age is so difficult. And the likelihood of them actually raising funds, I would argue, is very low. And, I think that what's so cool, and I think that there's two different things that really help, just to recap what you said. One, it's going to be like really tangible milestones. Like what can you accomplish with the smaller amounts of capital that shows that you're moving in the right direction? You maybe raise at like lower actual capital rounds. So instead of getting 10 million, you get 5 and you do exactly what you said you were going to be able to accomplish with that 5. And it's actual meaningful movement to making this happen. And the second thing is even if you're in a highly regulated industry, like look for like opportunities to have a less regulated product that you can bring to market earlier to show some type of product market fit, some type of execution on your part as an entrepreneur. And I think that that's just an invaluable lesson.
Yes, I can actually give you 2 examples. Yeah,
please.
So one company just went in our portfolio, just like went public. It's like called Crystal Pi. It spells like XTALPI. It's one of the biggest like AI drug discovery companies in Asia. So when you think of AI drug discoveries, even now today, we don't see the loop closed. Meaning like we don't even see like one single drug that are developed like from day one by AI that are got approved on the market. No. So if you go back to like say, almost 10 years ago when they founded the companies, how do they think it through the process? They know from day one, it's not gonna to be a validation soon. So they choose to, so basically, ultimately, when you do something like this, you have your core advantage. Their core advantage is that they have an algorithms that they can simulate the molecule reactions, like how molecule put together, like think it this way. So they purposely pick an application is they want to predict the crystal form of the drug, which is a very small piece of AI drug discovery. They pick this because it's easy to verify. Like large pharmas are already doing some other things too, and they need to figure out the crystal form. They need to figure out like if I have a molecules, they have 10 crystal form, I need to patent all the 10 crystal forms so my other competitors won't steal my valuable drug. So they need this, and this is easy to verify. So they start from there. It turns out like big pharmas like Pfizer's like them because it's like they see, oh, the result is pretty good. So we spend a lot of like labors to figure out 10. It's just one click for them to figure out 10. So sometimes 11. So that's good. That's doable. So they got their first kind of like few contracts by doing so. Like this is one example. The other example is also like, it's actually also like a very similar AI drug discovery thing. So we have like another portfolio companies got acquired last year. It's called Revela. It's built by a team of like MIT and Princeton PhDs. Essentially, they're also doing AI drug discoveries and synthetic biologies, like organ on chip kind of things to like screen out molecules. But they purposely choose not to use it for drug discovery. They used for like new molecules in wellness and cosmetic use, which is way less regulated by the FDA. So what's the result? We invest in that Revela company like March 2021. They get their first product launched to the market like early 2022, which is less than a year. They break even the whole companies like by the end of 2022, which is like by the end of the second year. And they got acquired early 2023. So that is like another typical example of like capital efficient. Like, I mean, I use this 2 examples to see like how you purposely design your path to achieve like something, like you said, some concrete milestones that you can show, which can be used to support your own companies. You're not solely relying on like, oh, there is like an angel, like a great investors giving you 10 more millions to help you to hit your next milestone. Yeah.
No, that makes total sense. And I mean, it's like that like analogy. It's like, how do you eat an elephant one bite at a time? Sometimes I feel like startups are trying to do the whole big project in one swoop, in one go. And it's like, just find how you can actually attack this and make it actually come to market. And yeah, I think that makes a lot of sense. So I have a question for you actually on this. So a lot of the investing styles or philosophies that I see VCs doing nowadays, it's not nearly as high risk as I would say it used to be, like even 5-10 years ago. You know what I mean? Like VC is by nature, VC is supposed to be higher risk because it's for early stage, 1 out of 10 investments are supposed to hit. That's the game. I see a more cautious approach, almost nearing private equity like standards, especially for like late stage seed Series A rounds. What are your thoughts on that? Like, how do you feel about the direction of the investment style that the market has as just like a standard per se?
I think that would be a natural thing. Like the so-called early stage fund or growth stage fund become too big. Well, I mean, if you're doing like a 50 million fund like us, it's actually, we take more risk because like the exit opportunities that kind of, we just can be more picky. We don't have like a high pressure to deploy capital that much. But if we're talking about like a 1 billion seed fund, think about it. What does that actually mean? Like a 1 billion seed fund. If you invest like 1 million every check, you need to invest in 1,000 company for a fund. If you invest like the 5 millions of checks, you need to invest like 200 companies a fund. So naturally the strategy will change, like how the GP operates the fund, it would be quite different. Or they are forced to write really, really big check early on. So in that sense, a lot of the time, I would say they need to consider a lot of like kind of risk management and also like some other financial engineering things to like mitigate the risk. Or I think that's one angle to think about it. But from the other angle, I would say like there are still tons of funds taking tons of risk. And then funds like us, we are still doing things like if one company out of 10 being very successful, it will return our fund, that kind of model. And then that's also like the interesting things investing early is that you have like a high multiple potential. So whenever in our diligence or in our IC meetings, like investment committee meetings, we always talk about, okay, if this specific company being very successful, is it possible to return our whole fund? Usually we will invest if the answer is yes.
So that is a great point. I have a follow-up question then. So this is a conundrum that I think some founders get in, right? So they have to balance the capital efficient communication. So we have a short-term plan that is going to allow us to stay alive and validate the technology that we're building to, like get investors interested. So they have to talk about the short term. In order to get capital, you're exactly right. They have to also talk about why this is venture scale, because most VCs are looking for the exact same thing. Is this going to return our fund? Is this something capable of hitting X? You know what I mean? Whatever that number is for the fund specifically. So how, as a founder, do you think they can articulate that without making it sound like too small of an opportunity, but also not too big of an opportunity? That's kind of a delicate balance. Do you know what I mean?
Yeah. So I would say like I can only talk about like in our scenarios because like we do mostly deep tech. So when we see something, it's usually a tech platform. And then we always ask ourselves, like sometimes the founder will just tell us like, if ultimately this tech platform being successful, what would be the biggest problem can be solved? Like the ultimate goal that can be solved. And then what does it take to get there? So usually it takes like a lot more R&Ds or like a lot more like developments to be a product. So it probably also takes a lot more to invest in like the equipment or something like that to try and error. So then we ask the questions based on what you can do now. What would be some low-hanging fruit that you can translate it into the commercial values? That probably can be your first few steps, but don't forget, ultimately you want to solve that like moonshot goal. So sometimes I would say you don't necessarily need to convince the investor. Sometimes if you let them to see the possibility, they will convince themselves. They will help you to tell the story, or they will even like inspire you. Oh, this is some other bigger things that you can actually do. So
Right.
yeah,
I think
because
that
like I
makes a
mean,
lot of sense.
yeah.
You have to have the big vision, but then you also have to have like, these are the tangible things that we can do now
Right.
that are
No,
going to
I
get us
think
there, the
I
step
think
stones,
I
right?
think I think the big vision is actually stems from like the potential of the core technology. So I mean, if your core technology don't have that kind of potentials, it will be really hard to like talk about like a big vision. So like at least in the deep tech space. Let me give you another example. We invest in a company called Kula Bio. So their current application is that like they store energy into bacteria so that the bacteria can do their work without looking for food for a couple of weeks. In that way, they boost like nitrogen fixation bacteria to replace nitrogen fertilizer. So this is actually a pretty good first market because like synthetic nitrogen fertilizer is a huge problem for the world. It takes energy, it's like high pollutive, like, and it's damaging the soil. So people have been looking for solutions. Like people are trying organic, people are trying biofertilizer, but none of those are efficient enough to fully replace the synthetic nitrogens or cheap enough. So they figure out this way. They already proved that it's like cheap enough and it's efficient enough to replace synthetic. So all Harvard landscapes are using their products. There, you probably see their product launch to market like later this year or early next year. So this is like the first market. But ultimately, this technology is about like you supercharge your bacteria. You can use your imaginations. You can use that for other type of functional bacteria, which
Okay.
opens up the whole universe. That's how you tell the story, basically.
That makes a lot of sense. So it's like, what's application number one? And like, that's like
Yeah.
kind of like the go to market. But then it's like this technology, by definition, again, for your specific types of companies that you're investing in this deep tech space, it's like there should be multiple applications. But like, that's, you can't focus on all the different applications in the early days, or else you're going to have no focus, no
Exactly.
execution.
Yeah,
That makes a lot of
yeah,
sense.
let me give you another example. If you don't know what's your first application, sometimes investor would prefer to wait and see. That's
Mm,
actually what we did to some of our portfolio companies. We know them from day one. They didn't figure it out. We talked to them, they didn't figure it out. We just skip like the first round. We wait and see they find their first application. So then we go back, even with like higher valuation, but we see they start to work on something concrete. Yeah.
yeah. That makes sense. You tell me
Mhm.
this, what's your preferred way to stay in touch with founders, right? So if a founder is a little too early for you, they reach out, they have a really unique technology, you're like, well, I actually do just want to see what you're able to figure out on your own. Like, what's the best way for them to build a relationship for you and keep you
So
updated?
So I would say usually we are very responsive. So we have an internal systems, we have a pipeline like, oh, this guy we need to do weekly follow up. That guy we need to do monthly follow up. That guy we need to do like quarterly follow ups. But that is like the meaning like when we go through like the weekly follow ups, we will actively follow up with that person. But the founder can always come to us, tell us like what he or she is thinking now, what's the new findings, like what's the next steps or what's the planning. We are always happy to discuss with them, but especially in Boston areas, we always like have coffee parties, like
Hmm.
lunch dinners, like with all those scientists. So I would say just be proactive and catch me. So
Well, next time I'm in Boston, I better get an invite to one of those coffee parties,
yeah,
Hongkai.
of course. Yeah, like almost every month we will have like a party in our office.
Amazing. Amazing. Well, let's transition here a little bit. Let's talk about some mistakes because again, like who's listening to this podcast? It's going to be people that are building a startup for themselves, especially this one specifically. It's probably going to be a lot of deep tech founders who are like, I have this huge vision, this huge technology that I'm building, and I just need to raise money in order to make it come to market, right? That's where a lot of
Hmm.
founders sit. And they think the only thing holding them back is capital, right? So I think we've already
Yeah.
taught them a lot about how to think about the milestones leading up. I would be curious though, from your perspective, because you probably get reached out to a lot, right? By a lot of founders. You talk to a lot of founders. What are some of the most common mistakes when it comes to things that founders are telling you about their business, about their idea, things that they are asking for? It could be valuation related. It could be really related to their product, like what we've talked about, the capital efficiency side of things. Like, what do you feel really turns you away from an investment? And you're trying to advise founders to avoid at all costs so they can increase the chances of having a better quality conversation or any
Right.
other.
I think one common pitfall, like for scientific founders, is that there's a saying like if you have a hammer, everything looks like a nail, right? That's especially true for scientists,
Okay.
because like like understandably, they often fall in love like with their like the problem, like the technology they have been building for years, right? They would see every problems as an opportunity to apply their solution. But that's actually not true. They need to realize that it might not be your technology, or your technology might not be the best solutions or the only solutions or the necessary solutions or like the cost efficient solutions for that specific problems. So you better think like reverse. It's first of all, the problem has to be long, like has to be huge. And then that kind of problems can only be solved by your type of technology. It's not like you are one of the options, but you are the only options. That is probably whoever are suffering that kind of problems will pay you early stage, like to have you build the solutions for that. So I would say this is like the first common mistakes. Don't start from what you have in your toolbox. Start from what kind of problems you're trying to solve. This is very important. It's like basically
That's
start from the
interesting.
demand. Yeah.
All
Start
right,
from the demand.
I'm going to give you a saying that we say. We say you're too focused on the product, not your prospect. Okay, so
Yeah.
similar. It's like you're so into the work, the technology, to where it's like you need to focus on what's the real world application of this. How does it actually become a market accepted technology?
Yep.
Because I think what you're saying is it's like, the science itself could be great, but it's like, what problem are you actually solving that people are willing to pay for that no one else can solve? You know what I mean? Like keeping it focused on the core problems that are going to be solved in the market. Is that the
Yeah.
understanding?
Or let me give you another example. Say, think about
Please.
Elon Musk, right? I want to go to Mars. Okay. That's a problem I want to solve. Well, the first method I try is that I go to Russia and buy a rocket. It does not work. Okay. Now I try to build my own rocket. Well, it's too expensive. Now I try to build a reusable rocket. Basically, it's kind of like a goal driven or a demand driven. He has a really clear problem he wants to solve. It does not really matter what kind of technology he's using as long as it works, right? So that is the kind of mindset ultimately, like if you really want to build a great companies, it's not
Yeah.
about the technology, this specific technology. Or maybe you start from the technologies that you have been working on through your PhD for 5 years. That's great. That's a great
Yeah.
starting point. But don't get too attached to that, because that may be a good solution now, may not be the good solution for the future. That may be a good solution for this kind of problems, but may not be for that kind of problems. But ultimately, whoever pay you, you need to solve their problem, right?
Right. Yeah, exactly. Yeah. Whoever's paying you, you need to solve their problem. And I think that really it's just pivoting, like knowing, understanding, and building this incredible technology. It's like, what's the real world application? And I love that you're giving so many examples. I feel like sometimes,
Yeah,
conversations can lack if you don't give specific examples, and you've done a phenomenal job of that today. So
yeah,
thank you very
yeah.
much. Tell me that. Okay. So you mentioned something about like, it has to be a technology that's so standalone that only you can do. Give me your perspective then on competitors, right? Because sometimes, and this could be industry specific depending on the VC that we're talking to. So sometimes it's actually a good thing to have competitors. It's good to show that there is a market that actually exists. So tell me a little bit about how, they don't make it sound too maybe science fiction-y for your specific industry. Like, is there a way for it to sound too science fiction, or should they be mentioning competitors? Like, what's the balance there? You know what I mean? To make
Yeah,
it seem like it's possible. Yeah.
you have to mention competitors. If it is a real problem, people trying to solve it, there's nothing, well, almost nothing that only you realize that it is a problem. It
Right.
is a problem because everybody knows it is a problem. So it is hard to solve. People have been trying to solve that for decades, probably, or if not hundreds of years. Like, I mean, people trying to do like fusion for decades, right? So what you need to convince the investor is not that you are the only solution trying to solve that problem, but is that like what kind of advantage or what kind of the unique thing that makes your way to solve it significantly better than all existing other ways. If you can convince me that, I would take a bet, right? First of all, when we say venture capital, the venture meaning that is risky. So we don't know. I cannot predict the future. So all decision I make, it's based on current information, send my will towards the future. So yeah, you have to convince me it's worth like betting on you. Like, what's your new thing? What's your different thing? It's not necessarily saying that you don't have competitors. You most likely you have competitors. The more important the problem is, the more competitors you usually see.
It makes total sense. It's like your path to solving the problem is higher likely of success, higher likelihood of achievement than, the competitors that currently exist. And it's creating a really compelling case around that, which I think makes total sense. So I like that. With what you just said, I actually have another follow-up question. So how important is the individual, the founder themselves versus the idea? So it's my opinion, again, that there's, a lot of products out there. There's a lot of technology that's probably incredible. How important is like the actual founder to you in making a decision? Like a saying, it's like, are you betting on the horse or the jockey? You know what I mean? So like if they have an incredible technology, but the founder lacks certain skill sets, how do you approach that or vice versa?
Yeah, I would say it's always the founder for us. Think about cooking. The founder is like the chef, like the technology is like the ingredient. So ultimately it's the chef that make a great dish. Well, if you don't have like a good ingredients, you cannot make a great dish, of course. But like we see a lot of the times, like there is like great technologies, but like the technical founder is not, it's not a great fit to be a CEO or to be the sole founder. In that case, that happens all the time. In that case, we will encourage them to look around their network to see if they can find someone are more experienced in business or industries to work together. They convince that person to join the team, to commit their time to build the company together. That is actually part of the validation, I would say. So it's because like in some sense, like building an early stage companies is that you need to leverage the right resources at the right time. As a founder, you need to learn how to leverage your scientific achievement, how to leverage your personal brand, how to leverage your network, how to leverage external capitals, how to leverage like industrial partners to work together to help you achieve your goal. Because like ultimately we only have that much limited resources in early days. So that is kind of like if we see founders like this, we will introduce them to people, encourage them to talk to people, encourage them to recruit like co-founders from who they know. That's also kind of like a test to them. So we will see if they pass the test.
That makes a lot of sense. And yeah, I agree. Like again, like time and time again, it's like the execution of the vision is more important than the product and the vision itself, I think. It's like,
Well, I
is
mean,
this founder going to be resourceful? Right.
Your vision probably is very consistent, but your approach or your product is it change all the time.
Right. I really liked you're a master of analogies here. You're just talking about the chef and the ingredients that they're given. Like it makes a lot of sense. And I think that, I appreciate it. So let's talk maybe about this. I always end on like two bigger picture questions just because I personally like knowing where people think. So we'll wrap up here. So first thing that I'm really curious about are like, obviously you, especially you're in deep tech. So I'm really curious about your idea here. Big bets on AI, right? Right now, it's the craziest time in history for AI. Things are changing literally on a daily basis. Every startup has AI incorporated into what they do now. So, like, what are you betting on right now? What do you feel like some of the most big change, big impact is going to be in our day-to-day lives over the next 5-10 years with the development right now in AI?
We are incredibly bullish on AI. So I personally have like a supercomputer background. So my background is in mathematics and computer science. So basically we see it dramatically lower the cost of like intellectual labors across the board. Think about that, like especially the tasks that right now today that don't require rigorous like precise logics or like mathematics or something. Like think about activities like we have an interview right now, so summarizing the interviews, or after this call I need to prioritize my emails, or manage like customer interactions, or handling coffee like office administrations or something like that. So there are countless tasks that we want done, like, but only affluent individuals and high level managers can afford like hire people to do so for them. Like average people like you and I, we either have to do it ourselves or simply go without, like due to limited time and resources. So imagine like if AI agents can handle those tasks, perhaps not perfectly, but like well enough. This isn't just about like replacing human workers. We all talk about like replacing human workers, good or bad, but I think it's about like democratizing like access to services and capabilities that were once the exclusive domains of like those privileged few people. So yeah, so ultimately it unlocks a new capability. It used to be you need to take human power, brain power to do some task. Now it can be done by AI. They don't need to sleep. They can be everywhere. They can be with you 24/7. So that actually changed a lot of things. So in our internally, I can share with you like another high level thing. So internally, we have like theory. If a technology can change the world, has the potential to change the world, it usually has like three traits or characteristics, whatever you say. First is that it changed the cost structure of an important like industrial input. Second is that it enables a new way to organize like workforce or labor force. The third is that it opened up imaginations. Think about AI. AI lowered the cost of like intellectual labors or intellectual works, which it used to be like people pay a lot of money for employees to do something because they need them to like think. It's like an hourly rate. It's like if you can cut that into zero, you change a lot of things. A lot of business model, it used to be not doable because human is too expensive, suddenly become doable. And then it opens up like a new relationships, how like human work with machine. And then it opens up imagination, like naturally. So we are very bullish. We are very bullish on AI. And then I can share with you, I personally, now I'm looking for like a concept. Basically, I'm thinking like the evolution of like how human access information. When like the magnitude of information goes up more, like we've seen in the past 30 years, you need like smarter ways to distill informations because like the IO system of human being, ourselves, does not change that much. So we've moved from like simple catalogs like Yahoo, like to search engines like Google, like to personalized recommendations like YouTube, TikTok. So what's our next step? I think next steps, we are talking about like the AI powered curation systems, or I personally call it a curator. What do I mean by curator? An information curator is kind of like an agent that can understand the user's intent. It can break down a task. It can gather relevant informations, and then it can deliver concise, actionable results to you and I. So that because like now AI starts to generate all the contents, we will also need AI to help us to find relevant information that is useful for us. So something like this would be huge. Probably will be the next Google, the next ByteDance. Yeah, and then we also see like another very good news for founders, I would say, is that we see like those big guys, giant, they are spending tons of monies and efforts in building those foundation models, like the large scale AI systems training on massive data sets, that kind of like large language model or large models, whatever you call it. So we believe that this foundation models will become like a fundamental part of cloud infrastructure. So their capabilities will grow exponentially and their costs will plummet. So just feel free to create applications on top of it and believe that it will get better and cheaper very rapidly, like Moore's law say. So
Right.
Yeah, it's amazing time right now.
It really is, but you're totally right. Access to information now, I mean, there's unlimited information. And like you
Exactly.
said, like we can only store so much as humans. So how do we then pick and choose what information? And I think that maybe that's what Neuralink with Elon Musk, what he's working on there a little bit. It's like to be able to do that a little bit. And I'm sure that there's going to be many other applications that should be solving this exact same problem. Yeah, I know of a memory like tool. It's an AI tool that basically monitors everything you're doing on your computer, what you're saying throughout the day, and it basically
Yeah,
is.
rewind. Yeah.
Yeah, exactly. That stuff
Yeah.
like that, I think, is really making a big impact on the way that we're going to live our everyday lives. Like, I think Elon Musk was talking about how a robot's going to be like a car, you know? And I actually
Yeah.
completely agree. Like, imagine there's a full-time household like manager essentially for every single person out there. $20,000 person does every single thing that you want perfectly. What happens then? So
Exactly.
yeah, such a confusing future ahead. At least it's exciting, hopefully for most. And yeah, last thing to end on here, Hongkai. I appreciate everything you've said today. It's been phenomenal. Last bit of advice for founders. You know, there's so much going on right now. There's a lot of founders that, due to the market being down in terms of total, venture capital activity, they're in a tricky position. So what is your final piece of advice for any founder out there that's currently trying to raise money and it might not be going their way, or they're building a deep tech technology that they are trying to bring to market, whichever you prefer?
So I think I would give them probably two advice. The two advice essentially is one advice. So a lot of the times when we raise money, a founder think it this way: I need to raise such amount because I need to spend that much. I propose this valuation because this is the maximum dilutions I want. I'm willing to take. So this is the usual way like founders thinking. I encourage everyone to think it differently. Like reverse thinking. How much does it take to make the next milestone? Is there a way to spend less? How likely can I raise that amount? When I say how likely, think about this. If you need to raise 10 million to start with just an idea, ask yourself if you are like a repeat successful founders, reputable in your fields, or have like a rich daddy, right? If not, like rethink if this is like a good fit for you to do it right now. Even like Elon Musk, right? SpaceX is great, but even Elon Musk, he started SpaceX after he had like created and exited two successful companies like the Zip2 and PayPal. Right. By then, he has the capability to leverage that amount of capitals and resources to start SpaceX. Think about if you have like founder business fit at the current moment. That is one way to think about things. The other advice I would say is that once you figure out something that you think is practical to build, focus on building your own company instead of like hoping to get help from investors or benefits from external factors that are out of your control. So the hard truth is that most investors and resources tend to add a touch of luxuries rather than offer help in a difficult time. So equip yourself with like to weather any storms, like cheers if it ends up to be a sunny day.
I love that. There are two things that I really took away. I've never heard founder business fit. So like that's phenomenal. I think that every founder should be looking through that lens. And I wholeheartedly agree with your closing thought on like, making sure you're in a good position business wise when you're trying to raise money. It's the companies that don't need money that get money. And
exactly.
if you're in a bad position, why would someone give you money to fuel that bad position? And it's all about momentum. So building a business off of solid fundamentals that show that you actually are focused on, not just getting money and then lighting it on fire, for lack of a better analogy there. Yeah, I think that makes a lot of sense. Hongkai, thank you so much for your time today. This has been a masterclass, been extremely enlightening. And I think what you're doing is incredible. I'll be collecting all of the links too for people to be able to follow you on either LinkedIn or any other platform below. And also I'll put below best way for them to get in contact with you at Taihill Venture if they are building the next deep tech startup that you're going to be investing in. So thank you everyone who made it this far in the episode. This has been a phenomenal one. Make sure you like, subscribe, share this with a founder that you think would benefit from this. There are a lot of incredible tips that Hongkai has gifted us with today. With that being said, Hongkai, thank you so much. We'll wrap it up here and I'll talk to you soon. See you, everyone.